In 2023, the market saw plenty of challenges: high interest rates, geopolitical conflict, debt ceiling brinksmanship, threat of a government shutdown, student loan payments restarting, a troubled commercial real estate market, record and rising national debt, and even a banking crisis. In the face of each of these shocks, the market seemed to take Taylor Swift's lyrical advice and shake it off. The S&P 500 finished the year up 26%, while the technology-focused NASDAQ index was up about 45%. Bonds also notched positive returns after a difficult year in 2022. Equity market returns were largely driven by just 7 companies in the S&P 500: NVIDIA, Meta, Tesla, Amazon, Alphabet, Microsoft, and Apple. These companies individually jumped about 50 to 240% last year, in large part helped by developments in artificial intelligence. Since together, these companies make up about 30% weight in the S&P 500, they helped power the index to its 26% return. Taking an equal weighted basket of the same 500 stocks, returns were only up 13.7% last year. How is the market managing to stay so resilient? Aside from the AI enthusiasm, many now believe that the US economy is headed for a soft landing scenario, in which inflation comes down to the Federal Reserve's 2% target without an accompanying recession. The latest batch of inflation data has indeed signaled that inflation is moving lower, while the labor market remains healthy. Unemployment is below 4%, and though job growth has slowed, the number of jobs added has remained solid. After last year's 2% drop in earnings per share, analysts are forecasting double-digit earnings growth in 2024. Consumers continue to spend at a healthy clip, particularly on experiences and events, like Taylor Swift concert tickets. The Fed is forecasting that it will be able to make 3 cuts to its benchmark target rate this year, although market participants are, perhaps too optimistically, predicting around 6 rate cuts. So, is it time to pop the champagne and celebrate the soft landing along with everyone else? Maybe not yet. As Warren Buffett said, we try to be fearful when others are greedy. We are most focused on the potentially lagged effects of the Fed's monetary tightening campaign. We have not yet seen a recession, but it could just take longer for the Fed's rate hikes to negatively impact the economy. Credit card debt is at an all-time high, while interest rates for this type of borrowing sit around 21%. We're also starting to see delinquencies rise. While mortgage delinquencies remain low since many homeowners refinanced at favorable rates over the last few years, credit card and auto loan payment delinquencies have risen above pre-pandemic levels to 10-year highs. Student loan delinquencies have not yet registered, as they only restarted in October of last year. The market remains optimistic about the soft landing scenario, but we're staying vigilant, looking for other signs of delayed impacts from the Fed's tightening cycle. We remain disciplined about investing in high-quality companies with consistent cash flows and low levels of debt outstanding. Within our fixed income portfolios, we've extended duration with a barbell strategy in anticipation of future rate cuts.